What's going on, guys? Alex here, and today I'm going to talk about a question that I commonly get about living in one state and working in another. And that question is, will I be double taxed on the income that I earn at the state level? It's a great question. And the answer is, for the most part, no. You will not be double taxed in many cases, but there are some cases where that can be applicable. So let's back up a little bit. Let's try to understand what we're talking about and go from there. So let's say you live in the Sunshine State. You live in California, right? But your employer, who pays you through a W-2, has you working out of New York, right? So you reside in California, but for temporary purposes, just for work-related trips, you go to New York and you earn income in New York. Now, California wants to tax your income because you're a resident. California taxes worldwide income. So they're saying all that income, we're taxing it. But at the same time, since you're working in New York is also saying, hey, you're working in New York, we're going to tax that income. And the question then becomes, well, what happens, right? So California's taxing it, New York is taxing it. How do you reconcile all this goodness? So I put together a sample scenario to let you see the mechanics of how all of this can play out. Now, let's take a look at this example, and you'll see in a second the tax software. So what we did in this situation is we basically put together a return for a taxpayer who lives in California, who resides in California, but they work in New York for temporary purposes throughout the year. And I'm going to show you both the New York return and the California return, get an idea of how this is all playing out. So for purposes of the income, quite simply, we're looking at $100,000 that this person earned. Let's say they spent the year in New York, going kind of back and forth, but this $100,000 was earned during those times in New York. Now, we want to be careful that we don't establish residency in New York, because if it is a situation that you're spending the majority of your time there and essentially New York is your kind of central hub, there could be a residency issue there, which is a whole separate concept. But in this case, let's just assume that your residence is indeed California and you're a non-resident of New York for the entire year. That doesn't mean you didn't stay there, but that just means you didn't live in New York throughout the year. So with that said, this $100,000 is all applicable to New York. We have the withholdings also applicable at the state level. So let's say there was $5,458 withheld for New York purposes by the state of New York. And that's how this scenario is going to play out. So let's say you come back to California. It's time to file your tax returns. How's this all going to come together? Let's take a look. All right, so on the Form 1040, we see that there's $100,000 in income, nothing too crazy there. That's what we discussed. We're kind of keeping this simple. We're eliminating all the other factors in the scenario, just focusing on this particular point. Let's look at the New York tax return. So here we have a non-resident part year resident income tax return. In this case, we're assuming non-resident since you did not live there throughout the year. And looking through this return here, we can see that there's some allocation of the income. It's all allocated to New York, so we don't really have to worry about that. In this scenario, we're assuming that $100,000 was all earned there in the state of New York. And as we look through the return here, we see total New York state taxes of $54.58, and we're done. We were taxed in New York. We paid that tax. What happens on the California return? Let's take a look. Now, going to the California Form 540, we take a look here. We see the $100,000 in income is also represented because California taxes worldwide income. Since you're a resident of California, they take that $100,000 into account as well. And kind of working through the return here, we see that the tax calculated is $6,050. There's the exemption credit of $122 that California gives, so that's fine. So we subtract that out. We get $59.28 as the total California income tax. And as we go down to the credits section of Form 540, we see that there is a credit for other state taxes. And code 187, that's just how you notate it on this form. But this number should look familiar, $54.58. All right? And we can see that that's being subtracted out of the total tax liability. And what we're left with at the California level is total tax of $470. So what's happening is that the income was indeed taxed in New York, and you paid taxes on that to New York at the state level. What California is doing is giving you a credit for that tax. So the California tax, as we saw, was $6,050. $59.28 if you take out the exemption, and then we take out the taxes you paid to the state of New York to get the net California tax. So essentially, you're getting a credit for the taxes paid to that other state, and California is allowing you to reduce dollar for dollar the state tax liability in California based on the credit that you're getting for those out-of-state taxes. So this is a very simple example. It can get a little bit more convoluted than this, but essentially this is the mechanics at work when you have income that you earned outside of the state in which you reside. And it's interesting because New York is a high-tax state. But what can happen is if you're in a state that has a very low income tax, then you may still get the credit for the taxes you pay to that state in California, but at the same time, there's still going to be a lot of California tax that's going to be applicable. It can very well be that the state tax credit paid to the other state was $200, and you still have a significant tax liability. But here's where you'd look to see if you're getting credit for the taxes paid to that other state on the California resident return or wherever you happen to reside. And I mentioned at the very beginning, this does not apply in all situations. The reason I mentioned that is because some states do not allow such a credit depending on which state you reside in and which state you work in. And sometimes you may end up being double taxed depending on the state in which you live versus the state in which you work. Sometimes they don't play nice with each other. And if you look at the instructions to these forms, you'll see that some states say, oh, we'll give you a credit for these states, but we will not give you a credit for these states. So believe it or not, it gets pretty petty at the state level as far as where you can and cannot get a credit for taxes paid to different states. So the point is, in a good amount of situations, you will not be double taxed because of this dynamic of one state giving you credit for taxes paid to a different state. And it may work out that you get a credit by your home state for taxes paid to the other state, but it can be the opposite as well in that the other state will give you a credit for taxes paid to your home state. So either scenario is meant to avoid double taxation, but just keep in mind that you may very well end up in a situation where at the state level you're taxed on both sides, being the state in which you reside and the state in which you work, because they're not playing nice by applying credits respectively. All right. So hopefully this video gave you some understanding of the mechanics of state tax credits and the fact that double taxation is generally not applicable at the state level, but it can be in certain circumstances. And if this was helpful, feel free to hit that like button, leave a comment, subscribe to the channel, hit that bell icon to be notified of future videos because there will be more. And aside from that, as always, hopefully this was helpful. Thanks for watching.